The ASEAN+3 Macroeconomic Research Office, or AMRO, is urging policymakers to reinforce their fiscal risk management amid geopolitical uncertainties and structural headwinds. It expects regional economic growth to moderate this year after significant shifts in global trade conditions triggered by US tariffs. But governments could continue to feel pressure due to rising risks like oil volatility. Now, Singapore was among the economies cited in the AMRO report that had better than budgeted fiscal balances last year. It adds Singapore is in a relatively strong position with its ample fiscal space. This allows it to respond flexibly to shocks. AMRO says measures taken by Singapore, like its newest support package, highlights its systematic risk management.
We think that it's timely and appropriate, especially it's like a subsidy for the most vulnerable, and also some of the tax rebates for the affected sectors. But what we want to highlight is that those measures should be targeted and temporary. So that means if these kind of risks subside, then these temporary measures should be withdrawn without further extension.
And let's discuss this further with Dr. Luke Hong, who is a group head for fiscal surveillance at ASEAN+3 Macroeconomic Research Office, or AMRO. Now, Luke, how serious is the strain on the region's public finances right now?
First of all, good evening. And that's exactly how we characterize the general fiscal situation of this region in our recent report, ASEAN+3 Fiscal Policy Report, or in short, AFPR 2026, which is published this morning. In this report, we mentioned that many ASEAN+3 economies are facing clear fiscal pressure, not because of a single crisis, but because of accumulated impacts from successive shocks since the COVID-19 pandemic. So these successive shocks required a series of fiscal support measures, and therefore fiscal position has substantially weakened, and fiscal space has narrowed across many economies. But at the same time, fiscal policies still required to respond to near-term risk, which we know remain elevated, and also required to support long-term economic growth while addressing structural challenges. Despite this challenging environment, higher pressure do not necessarily mean the situation is beyond the control of fiscal authorities, fortunately. Member economies have continued access to financing, which is one of the critical factors that we are looking at. And many are actually taking steps to strengthen fiscal framework, which help them create the additional policy room to adjust gradually. So in this context, our AFPR 2026 highlights the importance of strengthening the fiscal management framework for more resilient, sustainable, and inclusive growth. Let me stop here for this.
So how is Singapore specifically coping in this environment? Is enough being done? I know the report does mention that Singapore is in a relatively strong position.
Yeah. Well, while we are doing the fiscal surveillance of our member economies, what we found is that all ASEAN+3 economies are quite different in fiscal policy as well as their fiscal positions. But Singapore is also the same. So in particular, Singapore is well known for its strong fiscal discipline, supported by fiscal rules and the political commitment, and also the prudent borrowing practices, which together led to sizable fiscal buffer. Also, we'd like to note that Singapore is one of the 4 member economies that you mentioned, whose fiscal balance in fiscal year 2025, last fiscal year, turned out to be better than the pre-pandemic averages among the 14 member economies that we are doing the fiscal surveillance. So although the expenditure as a share of GDP remain elevated with various support measures, revenue collection outperformed significantly, leading to a sustained improvement in fiscal balance. So, for example, as my colleague mentioned, in response to recent oil price shock, Singapore government was quick in providing the additional support to households and businesses while strengthening the contingency planning. So this is exactly aligned with the policy suggestions of our report.
Now, despite its fiscal discipline, Singapore's public debt is quite high on paper, and a lot of it is linked to CPF. So how concerned should we be about this situation, especially given the volatility of the global environment right now?
Yeah, as you correctly pointed out, Singapore's government debt number looks very high, like at around 167% of GDP as of end last fiscal year. Although it is a little bit lower than the peak in 2023, but this number is the second highest among ASEAN+3 economies, as you can imagine, just next to Japan, which is around 213% of GDP. And surprisingly, more than double of the third largest member, which is around at 77%. But as highlighted in our report, Singapore's gross public debt is mainly used for non-spending purpose, especially related to the development of domestic bond market and providing the investment instruments to many investors. This is clearly different from the usual case in many other economies, where the government debt is mainly to finance the fiscal deficit. We also would like to note that this high debt level is in gross terms, so that Singapore's net asset position, incorporating both liabilities and assets together, remains positive, implying that even if the size of debt is pretty high, the size of asset is actually bigger than the size of debt. So I think these overall features surrounding the high debt statistics are well communicated with the market and the public as their understanding is better. So it clearly reflected in the Singapore's AAA sovereign credit ratings. Let me stop here.
Luke, thank you so much for sharing your thoughts with us. That was Dr. Luke Hong from AMRO.